two of what really are the biggest stock movers, Alphabet and Microsoft, on the move. Both reported earnings after the bell yesterday, and Alphabet's big beat came amid a rise in online ad sales. Microsoft saw its biggest revenue growth since 2018, and joining us to talk about both of those stocks and try to help us figure all of this out is Stephanie Link, Chief Strategist at Hightower, and of course a CNBC contributor. Steph, you can answer the question that Joe just asked. Do you think these companies are better off if everybody's stuck at home?
Good morning. Wow, they're just two powerhouses, right? I mean, but Alphabet, I mean, I'm just blown away with those numbers because the stock was up 31% into the print. Just look at these numbers. Search up 30%, an 8% beat. YouTube up 50, cloud up 45, free cash flow 50% beat. I mean, and the buyback is huge. So, I mean, this company is just doing so well. I think the stock is doing better in the after hours, not only because the numbers were so good, but because the stock really has lagged over the last couple of years. And at the same time as it's lagged, they've increased their partners by 5 times. They've increased their sales force by 3 times. And the operating leverage is enormous. I was really nervous that the operating leverage wouldn't actually come in as well as it has in the last couple of quarters, because it was so impressive over the last couple of quarters. But operating margins 30% versus 19% expectations. I mean, the numbers are just crazy. Microsoft is more expensive. Microsoft saw a 2 percentage point decline in their cloud business, but still really impressive. Azure at 46%. Right. So these are great companies. But you know, on margin, I think the Alphabet numbers were much better. Microsoft, high expectations, good numbers, but I get why it's selling off.
Steph, I want to go back to Alphabet for a second, because I've always thought that YouTube, and I think it was proven this past quarter, that YouTube is a juggernaut in a way that's so often underestimated in terms of what it means, not just to the industry, but just pure revenue. And you look at the revenue number on YouTube alone, and you can make the argument that this from a revenue perspective, looks like Netflix, or it's on its way to being Netflix. And the question is that just embedded in the price? Should the stock be re-rated? Is there something else going on? Maybe you don't like the ad business relative to the subscription business. I don't know. But I look at that and that blew me away.
Yeah, no, I mean, across the board, and you're spot on in terms of YouTube and focusing on that too, because obviously those are the trends, and they are benefiting from stay at home, work from home, and all that stuff. But these are the trends, Andrew, right? This is what's happening. We are in a massive change, a secular change. And so they are benefiting. They are executing. Digital advertising was so depressed last year. It's now recovering. So this only gets better, in my opinion. And then let's throw in on the search side. Let's just throw in travel. That hasn't even really kicked back in, right? So you've got a lot of ways to win with this name. You've got stay-at-home YouTube, but you've got return to work and return to life and reopen with search, and then cloud is absolutely on fire. So again, I mean, it's not cheap. It's 30 times earnings. Right. But when you have these kind of growth numbers and the fact that the last 2 years the stock has lagged, I think it continues to work.
Play Microsoft out, though, for us, because of the issue I think we were talking about, which is originally there was a view there was sort of a pull forward piece, right? Pandemic happened. Yeah. A lot of companies had to switch gears. They had to buy a lot of new product. They had to subscribe to a lot of new cloud services and the like from Microsoft. Now we're going to get into this hybrid world of sorts. There's going to be a whole new set of product and other things that companies are going to have to buy and sign on to. That's a great subscription business. People love to give a great multiple to a subscription business. But is this a sustainable business and a sustainably growing business at this kind of rate?
You know, it's a really good question. They had 2 years of digitization in 2 to 3 months time, right? So that's what they said 2 quarters ago. So obviously they're benefiting. I do think there's a pull forward, and I think that's one of the reasons why the stock is down. The stock's up 16% in the past month, right? So, but look, commercial bookings was the best number, up 39% in 5 years, right? And total revenue for this company, as big as it is, up 16% year over year. Operating margins up 380 basis points. So, yeah, was it pulled forward a little bit? Probably. The stock is not cheap. I don't own it. I actually trimmed, I sold it, and I'm looking, if it gets down a little bit more, I would buy it back because they're doing all the right things. This company also is benefiting from stay-at-home, but then also reopening. So, you know, I get it. It's just not cheap. That's the problem. It's expensive at 34 times estimates. And so when you don't actually blow it away like they did last quarter, and there's a couple things to nitpick at, I get it.
Shepard Smith here. Thanks for watching CNBC on YouTube.